You've saved diligently in your 401k or IRA for years. But now you're 50 and you want to retire early. But there's a problem. Most tax advantaged accounts lock up your money until 59 and a half unless you pay a 10% penalty. But what if there's a way to access that cash without getting hit with the penalty? One of my clients just retired at 50, and I'm going to show you the exact strategy he used to do it while paying less than 4% per year in taxes. The problem with retiring early is most tax-advantaged accounts have age restrictions on withdrawals. So how do you create income before 59 and a half without running out of money or going back to work? The general rule of thumb is that between a 3.5% and 4% withdrawal rate adjusted for inflation each year has a very high success rate over 30 years. But we're going to take it a step further because in 30 years, he's only going to be 80. So we want to project out to age 100 to be absolutely certain we can retire and stay retired. So today I'm going to show you how to do just that. Retire early at 50 while minimizing taxes and avoiding penalties. But first, if we haven't met yet, my name is Will Hinder, and I'm a financial planner and IRS enrolled agent. And as your virtual financial planning partner, my firm helps you lower taxes, invest smarter, and make work optional. So make sure you smash that subscribe button for more. Okay, we're here at the whiteboard, and today we're looking at Jim, who is 50 and single, and has worked in tech for about 25 years, and most recently earned about $300K a year before retiring at the beginning of this year. He's diligently saved about $1.5 million across a 401k, a taxable brokerage, and a Roth IRA. He owns his $500,000 home outright, and his lifestyle expenses are about $5,000 a month. Money isn't necessarily the issue for Jim. The problem is how to access those funds in the most efficient way possible. And what I mean by that is by paying the least amount of taxes and penalties. So since we know you can't access most retirement accounts without a penalty before age 59 and a half, what is someone supposed to do who wants to retire early? Well, there's a really underrated strategy called IRC Section 72T, or substantially equal periodic payments. This lets you pull money from your retirement accounts before the age 59 and a half barrier while avoiding that 10% early withdrawal penalty. But there's a catch. You gotta follow some specific rules set by the IRS. First, you need to commit to taking substantially equal payments at least once a year. And these aren't random withdrawals. They must be calculated using one of the 3 IRS-approved methods: the required minimum distribution method, the fixed amortization method, or the fixed annuitization method. And here's the kicker. Once you start these payments, you're locked in for 5 years or until you hit 59 and a half, whichever takes longer. And if you mess up the payment schedule or amounts, the IRS can retroactively apply that 10% penalty to all of your previous withdrawals, plus interest. It's like a deal with the IRS. No penalty if you stick to their payment plan, but no changes allowed either. Let me show you how we did it. First, we started by rolling his old workplace 401k into 2 separate traditional IRAs, $600,000 in one, $400,000 in the other. So why do we do this? Well, if we put it into one IRA, the SEPP calculation would be locked in on the full 1 mil. Splitting it gives us more flexibility. Because remember, once we begin the SEPP period, we can't really change it until we hit 59 and a half, when we can take withdrawals like normal. So we need to be thoughtful when considering how to approach this. So now that we know that we want to only use 72T on the larger $600,000 account, we can calculate what the substantially equal periodic payments will be. And it looks like the most we can take out per year based on the IRS's guidelines is $37,153, which will be our mandatory withdrawal from the larger IRA for the next 9.5 years. I know you're probably thinking, but that $37K isn't even close to the $60,000 a year Jim needs for spending. So where are we going to come up with the other money to get our $5,000 a month of spending needs? Well, Jim's $300,000 taxable brokerage account is yielding about 4% a year in qualified dividends, which is about $1,000 a month. And we'll also withdraw $1,000 a month of long-term capital gains from that account as well. And since the account's also being drawn down, the dividends received will be less as the years go on, so we'll need to make up a little bit of spending from elsewhere in the future. And this puts Jim's annual income right around $61,000, which covers his annual spending need. And most people don't realize how great taxable brokerage accounts are, especially when bridging the gap between early retirement and accessing retirement accounts at age 59 and a half. Long-term capital gains and qualified dividends are taxed at a 0% capital gains tax rate for a single filer under $48,350 of taxable income in 2025. So even though our total income is $61,067, that $23,915 of withdrawals Jim took from the taxable account will actually be tax-free once you factor in the $15,000 a year standard deduction, which brings his taxable income below the $48,350 threshold and into the 0% capital gains tax bracket. So with just a little planning and managing his income, we can take almost $24,000 of income totally tax-free without even using a Roth IRA. And speaking of the Roth IRA, Jim could also withdraw his own Roth contributions without tax or penalty if needed. But for this example, we don't. And since there's no state tax in Jim's home state of Nevada, he pays just $2,422.50 of federal taxes on over $60,000 of income for an effective tax rate of just 3.96%. So now that we know that we can access some of Jim's money pre-59 and a half to meet all of his spending needs of an early retirement without realizing any penalties, and also while keeping his taxes really low. But we need to know if it's sustainable. Because remember, making it to retirement isn't enough. We need to be able to stay retired. And since Jim is retiring much earlier than typical, we need to be even more cautious to make sure that his money will last. And that's why we project out to age 100, with Jim earning a fairly conservative 6.5% rate of return, with inflation projected at 3.25%. And we can see that Jim will have plenty of money to retire and stay retired no matter what. Early retirement doesn't have to wait for arbitrary age restrictions if you follow the IRS's rules and have a plan of action. By being creative and structuring Jim's income and withdrawals from various places, it makes it really easy to estimate his income for things like the 0% capital gains tax bracket and the premium tax credit to keep his health insurance costs lower before going on Medicare. His annual withdrawals also stay right around that 4% safe withdrawal rate. And after running the numbers, I can say with confidence that Jim can retire at 50 and stay retired based on his lifestyle, assets, and spending. Retiring early isn't just about money, it's about freedom. And Jim now has the freedom to spend time how he wants without worrying about running out of money or paying unnecessary taxes. If that's the kind of life you want, I can help you get there. Because the sooner you start planning, the sooner you can make work optional and start living. If you want my help like Jim did, go to my website, pursuitstreetadvisors.com, or click the link in my bio to talk. See you next time.